Welcome to StokTok's deep dive into Newmont Corporation. Newmont is the world's largest gold producer, operating a geographically diversified portfolio of mines across multiple continents, generating revenue from precious metals extraction and sale. At the time of recording, the stock is trading at 116.5 per share. The 52-week range spans from 48.27 on the low end to 134.88 on the high end, placing the current price roughly in the upper half of that range. The 50-day moving average sits at 114.68, while the 200-day moving average is at 94.4, indicating an upward structural bias over the intermediate and longer-term horizons. The Relative Strength Index, a momentum oscillator measuring overbought and oversold conditions, sits at 53.4, which is neutral territory, neither suggesting excessive buying pressure nor compelling capitulation. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Newmont's business model centers on the extraction, processing, and sale of gold, copper, and other precious metals from operating mines in the Americas, Australia, and West Africa. The company's competitive moat is rooted in several structural advantages. First, the sheer scarcity and inelasticity of gold supply globally creates durable demand. Second, Newmont's geographically diversified asset base and operational scale provide cost advantages over smaller competitors. And third, the company has built long-standing relationships with host governments and demonstrated operational excellence across complex mining jurisdictions. The StokTok score stands at 63 out of 100, which registers as a hold. Breaking that down, valuation scores 4 out of 20, signaling stretched valuations relative to historical ranges. Financial health scores 20 out of 20, reflecting fortress-like balance sheet strength. Profitability scores 16 out of 20, indicating solid but not exceptional margins. Growth scores 15 out of 20, suggesting moderate but decelerating expansion. Smart money scores 8 out of 20. A red flag indicating institutional and insider capital is pulling back from the position. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing 12-month price-to-earnings ratio is 18.23 times, which sits above the historical median for diversified mining companies, which typically trade in the 14 to 16 times range. The forward price-to-earnings multiple is 11.53 times, suggesting that if the company delivers on street expectations, the valuation multiple will compress significantly. However, the price-to-earnings growth ratio, the PEG ratio, sits at 3.07. Generally speaking, a PEG ratio above 2 to 2.5 signals that the market may be pricing in optimistic growth that warrants scrutiny. The enterprise value to EBITDA multiple stands at 8.75 times, which is reasonable for a gold producer with stable cash generation. The price-to-sales ratio is 5.69 times, higher than the sector median of approximately 3 to 4 times, again pointing to a premium valuation. From our view of the data, Newmont's competitive moat is genuine. The company operates some of the world's lowest cost mines and has demonstrated pricing power in a rising commodity environment. That said, the market is clearly pricing in continued strength. Wall Street analysts at the time of recording have a consensus mean price target of 142 per share, with a high target of 176 and a low of 72. 20 analysts cover the name, and the consensus recommendation is buy. The next earnings report is due July 23, 2026, with the street expecting earnings per share of approximately 2.22. Now, regarding valuation metrics from GuruFocus. At the time of recording, the GuruFocus Value estimate is 66.95 per share versus the current price of 116.5. That implies a margin of safety of negative 74.01%. Meaning the stock is trading at a significant premium to the value estimate. In our view, this valuation gap reflects the market's conviction about Newmont's operational excellence and the structural tailwinds in precious metals, but it also suggests limited margin of safety if sentiment shifts. Market sentiment around Newmont, as of the creation of this video, leans bullish, driven by record cash flow generation, robust buyback activity, and analyst confidence in the gold and copper supply-demand dynamics. However, operationally, there have been concerns raised around the Cadia asset update that warrant attention. The setup here, from a valuation standpoint, looks stretched relative to historical metrics and to the GuruFocus intrinsic value calculation. For value-oriented investors, the premium valuation presents a headwind. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 9 out of 9. This is a 9-point health checklist developed by Professor Joseph Piotroski that evaluates profitability, cash flow generation, leverage, and operational efficiency using 9 yes or no questions from a company's financial statements. A perfect 9 indicates exceptional financial health across all dimensions. The Altman Z score is 4.57, which sits well above the 3.00 threshold that generally signals a safe zone. Companies below 1.81 are considered distressed, between 1.81 and 2.99 are in a gray zone, and above 3 are considered safe. Newmont's score of 4.57 puts the company firmly in the safe category with virtually no bankruptcy risk. On the debt side, the story is equally compelling. Cash-to-debt ratio stands at 1.48, meaning the company has $1.48 of cash and cash equivalents for every dollar of debt outstanding, a very comfortable position. Interest coverage ratio is 48.14 times, meaning the company's operating earnings cover its annual interest expense nearly 50 times over. This is fortress-like. The current ratio, a measure of short-term liquidity, calculated as current assets divided by current liabilities, is 2.29, well above the 1.00 minimum threshold that indicates the company can easily meet its short-term obligations. The debt-to-equity ratio is 0.17, indicating that for every dollar of shareholder equity, the company carries only 17 cents of debt. All of these metrics paint a picture of a company with an exceptional balance sheet, significant debt capacity, and virtually no financial distress risk. The verdict here is unambiguous. Financial strength is a core competitive advantage for Newmont. The balance sheet is not a constraint on strategic flexibility or shareholder return initiatives. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, is 13.72%. This metric measures how effectively the company deploys capital to generate profits. In other words, for every dollar of capital the company has invested in the business, it is generating 13.72 cents of pre-tax operating profit. A return on invested capital above 10% is generally considered strong, so Newmont sits solidly in that territory. The gross margin, revenue less cost of goods sold, divided by revenue, is 53.21%. This is exceptionally high and reflects both the scarcity premium of gold and the company's cost leadership position. The operating margin, calculated as operating profit divided by revenue, is 48.63%. This is remarkable. It means that of every dollar of gold the company sells, nearly 48 cents flows down to operating profit before interest and taxes. The net profit margin, or earnings divided by revenue, is 31.25%. This indicates that even after accounting for interest, taxes, and other expenses, Newmont converts over 31 cents of every revenue dollar into net income available to shareholders. The free cash flow margin, which is operating cash flow less capital expenditures, divided by revenue, is 32.20%. This tells us that the company is not only highly profitable on an accounting basis, but also generates enormous amounts of actual cash that can be returned to shareholders via dividends or buybacks, or deployed into growth initiatives. What stands out across this entire profitability profile is consistency. From gross margin through net margin to free cash flow margin, the company is extracting substantial value at each stage of the income statement. The verdict is clear. Newmont is a highly profitable business with pricing power and operational discipline. Onto growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 23.90%. This is strong absolute growth, driven by both higher gold prices and operational expansion. However, when we look at the 5-year growth rate, it drops to 5.70%. This is a meaningful deceleration. What this tells us is that the recent strength is heavily weighted toward the past 3 years, likely coinciding with a significant re-rating in gold prices and strong operational execution. The longer arc of 5-year growth, however, is more measured, suggesting that Newmont's organic growth is moderate. The company is not a high-growth enterprise in a structural sense. Book value growth over 3 years is 8.40%, which is solid but again not exceptional. Dividend yield is 0.87%, which is modest. At a 116.50 price with this yield, shareholders are primarily looking for capital appreciation or buyback-driven returns, not income generation. One might argue that the dividend yield being compressed reflects the premium valuation we discussed in the valuation scene. The setup on growth is this. Newmont has demonstrated strong momentum over the past 3 years, benefiting from favorable commodity price environments and operational excellence. However, the 5-year record suggests that long-term organic growth is moderate, and the recent acceleration may be partly cyclical. The data warrants some caution on extrapolating recent growth rates into the future without evidence of structural acceleration. Now let's talk smart money. What institutional capital is actually doing with this name? 15 top-tier super investor gurus, as cataloged by Dataroma, currently hold Newmont in their portfolios. This is a respectable number and indicates that serious institutional capital sees value in the name. However, the activity direction is worth noting. Christopher Bloomstrand at Semra Augustus Investments, who holds Newmont at 7.62% of his portfolio, has been reducing the position, trimming it by 2.21% in recent activity. First Eagle Investment Management, holding 2.41% of their fund, has made a more aggressive reduction of 12.25%. Harry Byrne at Soundshore holds a 0.28% position with no recent change. Mayors and Power Funds held 0.00% or no position. What we see here is a mixed picture. While multiple high-conviction investors hold the name, the recent activity skews toward trimming rather than accumulation. This is a yellow flag. Of the 13F institutional filers tracked, only 10.4% are net buyers, meaning they own more shares than they are selling. A reading above 50% would signal net bullish positioning. We are well below that threshold. Insider ownership stands at 0.45%, which is very low. Management owns almost none of their own company. Over the trailing 3 months, there have been 0 insider buys and 9 insider sells. This is perhaps the most striking data point in the smart money section. When management is selling and not buying, and when top guru investors are trimming positions, it sends a signal that despite the fundamental quality and the bullish analyst consensus, sophisticated capital is rotating out. The bear case rests in part on this disparity between what institutional investors are doing and what Wall Street analysts are saying. In our view, this gap warrants attention. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a significant premium to historical averages and to GuruFocus intrinsic value estimates, with a negative margin of safety of 74%. This is a headwind for value-oriented investors, though the bullish analyst consensus suggests the market believes this premium is justified by operational quality and favorable commodity tailwinds. On financial strength, the company is fortress-like, perfect Piotroski score, safe Altman Z score, minimal leverage, exceptional liquidity, and enormous debt capacity. This is a significant competitive advantage and a core strength. On profitability, Newmont is a cash-generating machine with gross margins above 50%, operating margins near 50%, and free cash flow margins above 30%. This is exceptional and sustainable given the company's cost position. On growth, the recent 3-year trajectory is strong at nearly 24%, but the longer 5-year record reveals moderate underlying organic growth. The risk is that recent momentum is partly cyclical and may not persist at the same pace without further commodity appreciation. On smart money, the signals are mixed and concerning. Top-tier gurus are trimming positions, institutional investor positioning is not bullish, and management is selling stock, not buying it. This creates a tension between what the fundamentals and analyst consensus suggest should happen and what sophisticated capital is actually doing. In our view, Newmont is a high-quality business trading at a stretched valuation, with fundamentals that are rock solid but growth that may be moderating. The compelling profitability metrics and balance sheet strength are offset by expensive valuation and bearish positioning from smart money. The setup warrants caution for new entrants, but existing holders may want to consider whether the valuation premium justifies staying invested given the smart money exit signals. This is not a simple buy or sell. It is a hold that requires ongoing monitoring of both operational execution and valuation multiples. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Newmont Corporation. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.